Hey guys, I'm just checking if any of you guys are able to hear me right now. If you can, could you type in the chat whether you're able to hear me? Okay, that's nice. Just let's give it another minute while we let's give it another minute while the rest of us stroll in, right? Today it's me, Desmond, who is going to be presenting you guys an introduction to Forex, right? So I'm seeing a couple of questions come through already. I'm just gonna see how I can expand this a little bit more. Okay, wow, it's okay. Audio is working well, nice and clear. And can you guys see the first screen of the webinar saying IC Markets webinar? Awesome, you guys are answering so fast. It really helps a lot. Okay, just let me expand this. All right, I literally have a screen that is open, right? Just monitoring everyone's questions that are coming in. So one thing I'd like to encourage everyone to do is that, if you have a question along the way, just feel free to ask straight away. All right, don't hesitate. Don't wait until the end of the yeah, don't wait until the end of the session before you start asking your questions because our webinars tend to be pretty exciting, pretty and can drag quite long. Hopefully, it won't drag longer than we intended it to today. But sometimes we might not have time at the end of our webinar to take the questions, right? So when you can, just ask your questions straight away. All right, guys. Now, now let's begin. Let's begin. So today we're gonna begin our journey. All right. So with every forex, with every journey into the world of forex, it is important to be rooted on a strong foundation. Right. It's like if you want to play soccer, don't just jump straight into a game. You need to learn the basics first. It's the same thing with forex because very often, the mistakes we make are silly mistakes and they can be costly mistakes, and these can be avoided by learning the basics, right? And especially whether it's the jargon and all that complicated stuff that we often see while trading forex, right? Today we're gonna just go through and hammer out all these things that that we as beginners should understand. Okay, now let's begin, right? So first and foremost, disclaimer. All right, so trading forex is a risky thing, right? So be sure to do your own due diligence and research before trading. And of course, this is a webinar, so anything that is shared in this webinar should not be construed as trading advice, right? Instead, just take it as educational, basically to educate yourself. And some of you guys might have noticed, but we have an awesome new what's the word for it, templates, right, for our webinar slides. Big kudos to the marketing team for putting that together. It looks really awesome now, right? And so introducing your host for today, it's your this is me, Desmond. I'm an external analyst and CEO of Everest Fortune Group and the Forex Army, right? So I run an award-winning research team, CFA, CMT, CFT accredited analyst, and we are 2019 and 2020 finalists for Best FX Research and Best Equity Research, right? So usually, we advise the banks and hedge funds and treasury departments out there when it comes to trading. And one thing that we tend to specialize in, right, is Fibonacci, Elliott wave, harmonics, correlations, and market structure. So don't worry, right? Don't worry if you do not, if this sounds like alien language to you guys or something, all right? Because at XC, No, I mean at IC Markets, what we're doing is we're going through an entire series, right? We're going through an entire series from beginner all the way to intermediate to advanced. We're going to cover many of these topics, from the basic support and resistance, supply and demand, looking at indicators, looking at correlation, Fibonacci, oscillators, divergence. We're going to cover all of that. So this entire journey will prepare you, to take on the markets, right? It'll be an exciting journey. And I'll be doing most of it. So we're gonna, you're gonna hear a lot of me, right? So, and I'm gonna see a lot of you guys. And before we begin, I just like to ask a question, right? Can you guys tell me which country you're coming from? So I have a rough idea. I can see that there's a couple of hundred people, close to 300 plus people here today. I'd like to know, where are most of us coming from? Right? Where are most of us coming from? Can you guys tell me? Is it Australia? Is it Singapore? Right? Where are you guys coming from? Oh, nice, nice. We got Hong Kong, Singapore, Romania. We got David from Australia, Jamie from USA. Nice. John Durkin from Australia, Pat Bond from UK. Wow, okay, nice. Oh, we got guys from Belgium here. It's nice. We got Luke Pans from Belgium, right? Australia. Let's see if there's oh, we got Alice from Ghana. Philippines, Australia, Bulgaria. Oh, nice. We have people. Oh, Jeff from Singapore. Nice to nice to see you. Right? I'm Desmond from Singapore too. Right? Slovakia. Wow, nice. Poland. You guys are coming from all over the world. That is awesome, man. That is awesome. Okay, now without further ado, let's begin this. Let's begin our journey. Right. So this is the agenda for today. What is Forex and how does it work? Right. After that, we'll tackle this very tricky issue of leverage. How are we going to use it? Right. High leverage, low leverage. How can we get the best out of it? And how do we be careful of it too? Forex jargons, making sense of the noise. Sometimes, whether it's on Bloomberg, whether it's on all these news channels, people love to use a lot of jargons, right? And the problem with jargons is that, the moment you don't understand it, it just makes things very messy, right? You just have that, suddenly you have that, you were following an article perfectly well, and then this random jargon appears like hawkish or dovish, dovish, right? And you're like, oh man, what in the world does that mean, right? And you just lose your train of thought, right? And that is what we're going to do today. We're going to tackle these forex jargons, and it's a time for you to ask some questions on some terminologies which you might have heard and you're not too sure about. There'll be the time for you to ask them, right? We'll be looking at type of trading styles and their time commitment. And lastly, we'll be looking at this technical analysis versus fundamental analysis, right? We'll be looking at it and seeing which which approach is better for which kind of trading style. Okay, it's exciting stuff over there. Okay, so let's begin with what is Forex and how does it work, right? So IC markets, one of the first few things you would see. Let me see if I can pull out my handy dandy pen. Oh, cool. There you go. See, I can draw stuff now, right? just let me erase that. Okay, I'm going to use this pen. Some might say excessively throughout the entire presentation, so bear with me, right? But yeah, so first thing you notice when you come into forex trading, you're thrown into this, you're thrown all these random symbols, right? You're thrown these random symbols like EUR, USD, euro versus the US dollar, and you're like, okay, I roughly understand that. I've heard of the US dollar around. I know what's the pound. I know what's the yen, but what is all this, right? And as a beginner, you're looking at this like, okay, I see a lot of currencies, right? I see a lot of currencies, but how can I trade it? What does it mean? What does it mean by versus, right? Why is there a versus? And sometimes on some platforms, you might see maybe it's AUD/USD. So what is that slash for, right? So these are some things you see when when you begin your journey into forex, right? And then to make things a little bit more complicated, you see raw spread account, see standard account, minimum, average, and like, well, what is this? I'm guessing these numbers have to be good. If not, they won't put it on the website, right? So you're just looking at it, and before you dive into looking at all the different currencies, whether it's majors, exotic, emerging, let's take it to the basics. Okay, let's take it to the basics. So at the core of it, oops, just how do I? Okay, I need to go back to my pointer. All right, at the core of it, right? Think of Forex as like a money exchange, right? Um, I know it has been a while. It has been a while since we were able to go on holiday. But each time we went on holiday, there'll be a place we look for, right? And there'll be the money exchange. And some people call it the money changer. But at its core, Forex is like changing money, right? Let's just say you have so I see that some of you guys are from Australia, right? So you have the AUD. Yep, you have the AUD. You have maybe you have 100 Australian dollars, right? You have 100 Australian dollars, and you need to change it to US dollars. Okay, fastest finger first. Who can tell me how much can 100 Australian dollars get you in US dollars? Can anyone guess? Okay, I think Alice says 110. We got O'Brien saying it's 76, right? David, pretty accurate, is 7634. I assume you're saying is $76.34, right? So guys, okay, we got 76, 76, $77, approximately $80. Germano, you're saying is $89, right? And Suleiman, you're saying is $90, right? So we all know the US dollar is stronger than the Australian dollar, right? And at the rate of, what is the rate? So let's just see the rate. Let's just see the rate of one USD to AUD, right? So one US dollar, right? One US dollar is equivalent to, to roughly 1.31 Australian dollars. Okay, so 100 Australian dollars can roughly get you. Sorry, my mouse is quite wonky here. 100 Australian dollars can get you roughly 76 US dollars. Okay, that is a rough gauge, right? And when you're taking money, and you're going to start exchanging it, right? We all have been in situations where we've seen so many money changers. Okay, and let me share with you let me share with you a scenario. Okay, let me share with you a scenario. You're at a money changer, right? You're at a money changer, and they have this notorious reputation of trying to kind of try and trick people and stuff, right? So you're at a money changer, and they're showing you, okay, one, Australian dollar, equals to 1.30 US dollar. Okay, I'm going to draw a zero here. This is a zero, 0 US dollar. And at the same time, you got one Australian dollar equals to 1.32 US dollar. Okay, so option A and option B. If you are an Australian and you are going to the US, which option is better for you? Which money changer will you go to? Will you go to money changer A, or would you go to money changer B? Right? Remember, you got 100 Australian dollars, and you're looking at this. You're at this money exchange. There's like so many of them, right? And there's you narrow it down to these two money changers. Money changer A says, it is. I'm gonna give you, one AUD equals to 1.30 USD, while the other one says, one AUD gives you 1.32 USD, right? We got Jeff saying is A, right? Jeff, I hope you if you went to the arcade, right, where all the money changers are, Elizabeth saying is B, yeah, Umer saying is A, Germano saying is B. So we got a pretty good split of people. We got Clive saying is B, we got Abbas saying is A, right? So the correct answer, right? You think about it. You are an Australian with 100 Australian dollars. You want your Australian dollar to get you as much US dollar as possible, right? So you want your Australian dollar to be worth 1.32 US dollar. Okay, that means, right, for one in basically 1 Australian dollar can get you 1.32 US dollar versus money changer A. He's just going to say, for every Australian dollar that you're going to give me, right, I'm just going to give you 1.30 US dollars, right? So that means it's giving you less, right? And if you think about this, this is this is what happens. This is what happens on a daily, no, every year, or maybe every few months for a couple of us, right? When we want to travel overseas, we have to make these decisions of changing money, deciding, right? Deciding which money changer is better. It's kind of like looking at the different brokers and seeing what are the spreads that they have, right? Because essentially the difference between A and B is that one person is just taking a bigger cut than the other. And all of this, the bigger cut is down to this word called spread, right? What's the spread you're gonna pay? We will touch on spread a little bit later. Yeah, we'll be touching on spread a little bit later. Okay, right? But yeah, but it's essentially, if you we don't notice it, but every day, every year we have been involved in the world of Forex one way or another. Whether going on holiday, most of the times, going on holidays, right? So now let me give you a scenario, okay, guys. Let me give you a scenario. So before, you're this, you're an American. We're changing we're changing nationalities here, right? You are an American, okay, and you are going to Japan, right? And you're gonna eat some awesome, amazing sushi over there, right? Whether it's sushi, whether it's sashimi, for me, I'm a more of I love sashimi, right? So yeah, you're going there, and you need to exchange money, right? So before the holiday, you exchange 1 US dollar equals to 100 yen. Okay, you exchange 1 US dollar 100 yen. You go there, you have your fill of sashimi, otoro, salmon, swordfish, everything to your heart's desire. And at the end of the holiday, you're like, oh man, that was an awesome holiday. I'm coming back, right? And when you come back, and maybe after your 1 week holiday in Japan, you come back and you realize that your 1 US dollar is, remember, at the beginning of the holiday, you took 1 US dollar, and okay, no, you took 1 US dollar. Let's just say, let me give you a scenario here, okay? You had um, 1,000 US dollars, okay? You had 1,000 US dollars, and you changed it for 100,000 yen, okay? Now, so this is you going there. Let's just say you go crazy, right? You go crazy with with your sushi, and you're left with 10,000 yen, and you're going back to US, right? You realize that your rate has now changed. 1 US dollar is now equals to 110 yen. Did you make money or did you lose money? Guys, you want to make a guess? We got Jeff saying they lose money. We got Louis saying you lost money. Suleiman saying you make money. Ray Teo saying you make money. Peter saying that lost money. So what essentially happened here, right? 1 US dollar was worth 100 yen. Okay, if you change it back at this original, the rate over here, we're going to call it the rate A. What you'll be getting is, for 10,000 yen, you would roughly be getting, right, 100, $100, right? You'll be getting $100 back, right? This is at the rate A. Rate B, right? You'll be $10,000, and who can do the calculations for me at at rate B? How much would you be getting back at rate B? I need to take out my calculator myself. I can't find my notes. 90.9. All right. Okay, we got Abdul saying it's 110, right? That is because you're calculating it the wrong way, my friend, right? But you get roughly 90 US dollars, right? So you can see that in this case, the US dollar strengthened, right? So previously, all it took was 100 yen to get back 1 US dollar. Now you need 110 yen to get back 1 US dollar, right? So effectively, while you were in Japan, right, while you were in Japan and you coming back, you actually, because the US dollar strengthened, you actually lost money, right? You previously, assuming the rates didn't change, you would have been able to get 100 US dollars. But because the rate changed while you were holding Japanese yen, you lost money. However, right? However, if the next person who is going holiday here, right? Suddenly he has a better rate, right? Now he has 1,000 US dollars, right? And he can get 110,000 yen. 110,000 yen. You got 100,000. He got 110,000, right? So you can see, this is how the currency, whether a currency strengthens or weaken, it affects you depending on what you're holding. If you're holding US dollar and it strengthens, you're like, hooray, right? I've made money. But if you're holding yen, you're like, oh man, oh crap, right? I'm losing money. Okay, so remember, it's not only especially when it comes to current, trading forex, right? It's not just about one currency strengthening. It's also about the other currency weakening. You never ever look at it on one side, or USD versus nothing. You always need to look at USD versus something. There has to be something else. So in this case, it is the yen, right? So you can't just go around saying, oh, USD is USD is strengthening, right? And everyone's like, cool, yeah, USD is strengthening, and no one actually stops and asks, so USD is strengthening against what? Is it against a Malaysian ringgit? Is it against the yen? Because ultimately, it needs to strengthen against something else, right? So in the world of oh shucks, that's terrible. My drawing terrible. I was just trying to draw, multiple circles together. But yeah, it needs to strengthen against something. Okay, so that's the most important thing about Forex. Okay, you always look at currencies in a pair, one strengthen and one weaken. Okay, now let's go down to leverage and how do you use it? Okay, so this is how leverage works. Okay, these are rather the leverage options available in on IC markets, right? You notice that most of the leverage is 500. Where's my pen? Yeah, most of the leverage is, give me a second, I'm trying to use my pen to draw. Oh yeah, most of the leverage is 500 to 1, so it's great. It's a great thing. But the thing is, leverage is a double-edged sword. All right, it can be really good and it can be really bad, right? It depends on how you use it, right? And for the sake of learning today, we're gonna I'm gonna paint a scenario for you. Okay, now let's just say you have let me just change the color of my pen, right? Because I think yellow might be a little bit hard to see for people. Let's use green. I bet this is, IC markets is green. They'll love green. Let's just say you have a $1,000 account. Okay. Okay, you, know, you, um, yeah, you have two, you have two $1,000 accounts. Okay, account A and account B. Account A has a leverage of 1:50. Account B has a leverage of 1:500. Okay, now you both look at this popular currency pair called euro dollar, and you think that it's going to rise. Okay, you go in, you buy one lot here, and you buy one lot here. Okay, euro dollar goes up, right? Euro dollar goes up, let's just say 10 pips. 10 pips, okay? Basically just euro dollar goes up by the same amount. Who made more money? Okay, who made more money? Who made more money, guys? And don't worry, Jeff, I'll catch you later, right? And yeah, it's nice to see a fellow Singaporean here, right? Ibrahim, if the audio is not coming through, you should check it out because I think everyone is able to see the everyone is able to hear, so it should be fine. Right, guys. Okay, so who made more money, right? I see a lot of people almost unanimous, right, saying is B. Elizabeth saying is both are the same. Francis saying is both are the same. David saying it's the same. And a couple of people saying it's the same. A lot of people are saying B made more money. B made more money. Okay, so we have a question coming in from Debbie saying that, explain what leverage means. Okay, to explain what leverage means, we need to look at this example here and think, why does everyone say B make more money? Because the answer is both A and B would have made the same amount of money. Okay, this is an important thing that you guys need to understand, right? It is not just, leverage has nothing to do with what, how it affects your position. If you're buying one lot on euro dollar and you're buying another lot on euro dollar, whether you have a leverage of 1:50 or a leverage of 1:500, you will earn exactly the same amount of money. Whether it goes up, you will earn the same amount. If it goes down, you will lose the same amount of money. What leverage gives you is this important word called potential. Okay, it gives you this thing called potential. Look, I'm not saying it gives you a potential to earn a lot of money. I'm also saying it gives you a lot of potential to lose a lot of money. Okay, it gives you a lot of purchasing power, a lot of playing power. It gives you a lot of, potential, because it depends on the calculations, but basically the difference between 1:50 and 1:500, right? Of course, 50 and 500 is difference by a value of 10 times, right? 50 times 10 is 500. So basically, account B is able to get into 10 times more position than account A, right? Maybe if account A uses trades one lot, and he uses up all his margin, all his margin, right? Because basically how much margin he has is you take the account value, and you multiply it by the leverage. So he can trade up to, in this case, he can trade up to $50,000 worth. Did I get it right? Yeah, he can trade up to $50,000 worth. This is his margin. Okay, this is his margin for account A. For this guy down here, $1,000, and then you times the leverage of 500. What do you get? You get 500,000, right? You get 500,000 here, and this is your margin for B. That means you get to play up to $500,000 worth of of what's the word for it? Of trading. So wait, I guess yes, Lim Han Xiang, that is right. Singaporean, right? So that is what leverage is all about. Leverage is all about margin, right? How much margin, how much playing potential how much buying power, how much selling power you have. It has nothing to do in a direct sense. When you're just buying one lot on both accounts, it doesn't have anything to do with that. But of course, on account A, you can maybe buy one lot. But account B, maybe you can buy 10 lots, right? And that affects your, how that affects how much money you make and how much money you lose very fast. Okay, so that is one thing you need to know about margin, right? So as I think we had a question on margin earlier, right? And please explain what margin is by Debbie, right? Margin is just giving you buying potential. Okay, it gives you buying potential. So Robert is saying, yes, these webinars are beginners. Tell you more. Can you tell some more for advanced? Oh, yeah, Robert. Towards the end of this webinar, I'll share with you a little bit more about what we're going to cover for advanced, right? But it does revolve around trading strategies, right? Fibonacci, retracements, extensions, expansions, Elliott wave structure, correlation, oscillators, combining them together, right? It's fun stuff. But for today, right, we're gonna keep it slow. We're gonna look at the leverage, right? So we got David asking, could an account only buy 0.5 lot? That depends, right? That depends on how much is your deposit and how much is your leverage. Okay, and some people ask, what is the free margin, right? So free margin is basically unused margin. So sometimes at the bottom of your MT4, you have this thing called free margin. Free margin is basically let me see, right? You have total margin equals how much you use plus how much is free, right? So if you have $500,000 of margin, you already use up 400,000, you're only left with 100,000 of free margin. That's what it means. Okay. When the leverage is around 530, sorry, I'm getting some questions through, so I'm just gonna read it. Okay, so we got a question from Elizabeth, right? She's saying that if leverage gets reduced and she currently from 500 to 30 in March, and she currently has 10,000 in account, how much will she need in the account to trade at the same level? Technically, it's you just need to divide, right? So you 500 divided by 30, you need to top up your account by a factor of 16. Means you need almost $160,000 in your account. But let me remind you, right, guys, most of the time we do not use up our full leverage. We do not use up the full margin. No one goes all in all the time, right? And especially if you have you're using a 1:500 leverage, right? Most traders, they it's a good thing to balance off, right? Because if you know how to manage your risk properly, you will not be maxing out all your leverage at once, right? You must know how to pace your leverage. Don't go all in all the time, right? And this we will cover in trade management. I think it'll be the second or third webinar from now. But we look at how you can be profitable with a leverage of 1:50 or 1:30. You don't need a leverage of 1:500 to make a lot of money, right? Remember, it just gives you the potential. You don't even need to use up the full amount. Okay. Now, okay, getting a lot of questions, right? Okay, we got questions on swaps, leverage. So okay, we got Kasra saying if we have a leverage of 1:500, 1 pip movement means 500 USD. No, that's not true. Okay, so someone's asking, if euro dollar moves by 0.0001 pip, okay, let's just say, you have a position in, this is euro dollar, and it moves by, it increases by 0.01 pip. How much money in terms of dollar does this increase your account by? Can you guys take a guess? Okay, pips. Simon. Okay, we got some questions coming in. Sorry, let me just say, increased by 0.0001. right? Let me explain pips later. That's actually in jargons, right? I was supposed to answer jargons, jargons first, but looks like I skipped that out. That's good. That's a good idea. Next time I'll do a topic on jargons before we explain this a little bit more in detail. Okay, some people are saying it's 10 cents. Some says what is the spread? Some people say if it's one lot, it's 10 US dollars. All right, depends on the size. 50 boxes. I don't think you meant 50 boxes. I think you meant something else, Kasra. Right? And I like Paul Sell answer. I like David answer where he says it depends on the lot size. That is exactly true. One pip movement, or if price moves by this, by 0.0001, it does not mean price will go up by a fixed amount. You need to see how many lots you're trading. If you're trading, zero point 0.1 lot, it moves up by a certain amount. If you're trading 10 lots, it moves up by a lot more. Okay, so that is something important that you guys need to wrap your head around, right? Grasp. Okay, but let us move on. Okay, we are spending quite a little bit of time here, right? So let us move on in the interest of time, right? Let me see. In the interest of time, yeah. So this is just basically how margin trading works, right? I explained it to you just now, right? Margin gives you basically, leverage gives you more margin, and that just gives you more buying power, more playing power, more selling power, right? And a question of what's the common use leverage, right? A lot of people you like to use one is 100, one is 200, right? But it really depends on your trading style. For scalpers who use really big lot sizes, usually you need a very high lots leverage. For people who are using, maybe they're day traders or they are swing traders, they usually have a much smaller, a much lower leverage is okay for them. Okay. Now, let's just move on a bit. Let's just move on a bit. All right. So Forex jargon, making sense of the noise. Making sense of the noise, right? So these are just some of the jargons, right? And I'm just going to speed through them because, yeah, I'm just going to speed through them. So if you have additional questions on the jargons, feel free to ask me straight away. Okay, guys? Bullish basically means that price is going up. Bearish means price is likely to go down. When you hear people saying safe haven, this means when the world is in chaos. For example, like COVID-19 happening, right? These are the stuff that people run to. Safe haven can be the form of currencies like the US dollar. So US dollar or the yen usually strengthens a lot when the world is in chaos, like when the world has no idea, like holy smokes, man, what is happening in COVID, right? These currencies will strengthen because when all else fails, people know these currencies are very strong. And one of the other things is gold, right? When and this is one of the best, the most popular safe havens out there, because when people know that in a world where things are just thrown into chaos, the United States, it collapses because there's a civil war or something, right? There's Biden versus Trump, and things are in chaos. People are like, you know what? When all else fails, I know I can take 1 bar of gold and you fetch me roughly, it will be recognized as a universal currency. Whether I'm in Malaysia, whether I'm in Singapore, whether I'm in US, whether I'm in Japan, right? So that's what safe haven means whenever you hear it. Okay. Risk on, risk off basically means that for the day, usually it means for the day itself, right? Whether we are, in a risky environment or we're in a not risky environment. Means people are, risk on means that, there's a very, people are willing to take risk. So in equity markets tend to perform better. Risk off, people are saying like, whoa, 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 what is happening, right? We better take a step back. Things are a little bit scary. Let's go risk off, right? So when risk off happens, this stuff over here tends to maybe strengthen a bit. It gets a lot more complicated than that, but let's keep things simple for now. Bid and ask spread, right? Bid and ask, right? So one thing we need to look at is this thing called spread. So let's just say you're looking at euro dollar, okay? And for the sake of explanation, I'm just going to use a very simple fake price. right? So you got euro dollar over here. You got euro dollar over here. You got the bid price at 0.1. So this is the bid. Okay, 1.1. And you got the ask price at 1.00015. This is the bid and ask. Okay, if you're looking at your MT4 terminal now, you're looking at MT4 terminal and you'll say, okay, I'm gonna buy euro dollar. Which price are you buying it? Is it 1.5 or 1.1? Guys, which price are you buying it? Is it at the bid or is it at the ask? Okay, we got some people saying 1.1, some people saying, John saying is 1.5, John Leonard saying is 1.1, right? Kasra saying is ask. All right, guys, ask. Depends, you short or long. Let's just say, Faith, when Faith is saying it depends whether you're short or long, but when we are saying we are buying, right? So long means buy, short means sell. Okay, so in this case, we're buying, so we're going long. Okay, so yeah, a lot of people are saying ask price, we got people saying bid price, right? So imagine if you bought it, why we cannot buy it at the bid price is because in this case, there's like this arbitrage opportunity. It's crazy because if you bought it here, you can immediately sell it at 1.5 and you make money, right? You think about it, you make money straight away. If you bought it at the cheaper price, imagine if you are always able to buy at a cheaper price, you can immediately sell it off and make money. So that doesn't exist in this world, my friend, right? That doesn't exist in this world. So you're always buying at a more expensive price. And when you choose to go short or when you want to sell, you're always doing it at a cheaper price. Okay? You always buy at a more expensive price and you sell at a cheaper price. Okay, who can look at this, right? Who can look at this and tell me what is the spread? What is the spread on euro dollar in terms of pips? Looking at this, can people tell me what is the spread? I know it's 0.00004, but what is the spread in terms of pips? All right, because some people are saying it's 4 pips, some people are saying it's 0.4 pips. Most of you guys are saying it's 4 pips. Okay, we got Moses saying it's 0.4. Now, guys, remember when it comes to anything with the US dollar, most of them at least at the back, the fourth decimal place is where you look at for pip. Okay, the fourth decimal place is where you look at for pip. So if in this case, the difference between here and here is 0.4 pips. Okay, it's not 4 pips. Because if it's 4 pips, what you're looking at is 1.0005 maybe, right? And 1.0001, right? That will give you a difference of 4 pips. So you're always looking at the fourth decimal place. For any currency, for example, with yen at the back, like a JPY at the back, maybe it's 100.10. Remember, when it's yen, what you're looking at is the second decimal place, right? The second decimal place. For anything with USD, you're looking at the fourth decimal place. You can just go with this rule of thumb unless for exceptional cases, right? 1 pip refers to the second decimal place for anything to do with yen, and 1 pip refers to the fourth decimal place for anything to do with USD at the back, right? So next, let's just move on, right? When you look at hawkish and dovish, it's the same thing whether something is bullish or bearish. Something is usually more associated with what the Fed says. Lot size, lot size, we talk about it. When we're trading, right? When we're trading, we always look at lot size, right? So when someone says, "What's your lot size?" He's talking to you in about your MT4 terminal. What's your, how big are you trading? Major, minor, and exotic currency pairs. Right? Just let me erase my stuff here. It's just a lot of stuff, right? So major, minor, and exotic currency pairs. Most of the time we trade the majors because the majors tend to have the best spread. Okay, the minors are anything that doesn't have a USD in it, right? So let's say if a major is euro dollar, the euro dollar, who can tell me what does let's just say we pick two big pairs, euro slash GBP, two big major pairs. Does this fall under major, minor, or exotic? Euro GBP. Okay, I realized I didn't talk about slippage and liquidity. I'll talk about that in a minute. I got a whole bunch of people saying it's major, right? And we got a nice bunch of people, Abdul and Luke saying it's minor. Okay, guys, the answer is it falls under a minor currency pair, even though euro and GBP are super popular. The reason for that is that as long as any currency pair does not have the USD, I know it's a little bit biased, but yeah, they don't have the USD in them, it will automatically be considered a minor. Okay, you got the euro dollar, pound dollar, Australian dollar, Kiwi dollar, we got the dollar franc, the dollar CAD, dollar yen. Those are all major currency pairs. Anything that does not have a USD in it, right, becomes a minor. And exotic currency pairs are usually looked for more emerging markets, like even the Singapore dollar is considered like is exotic currency. The Malaysian ringgit, right, the dollar ZAR, African ZAR, right, all these things fall under exotic. Okay, yeah, so Miss Sel, yes, I can see your answer. I can see your questions, and you said major. Okay, so yeah, we got a question. What is slippage? Okay, so when we see, when we have a when you see a case, let me just erase this stuff so it's slightly easier to see, right? So let's talk about slippage. Slippage can be well, it depends. How many of you guys think slippage is a good thing? Is slippage a good thing or is slippage a bad thing? All right, we have Clive saying it depends. Guys, it depends. Usually bad. It's a bad thing. No idea what it is. Right, it depends. Work both ways. Yes. So super strictly speaking, slippage is actually a bad thing, but it's something that we must grow to live with. Okay. The best case scenario is when the markets are your connection to the broker is so perfect that there is zero slippage. What price you want to get in, is the price you get out, right? So you execute at this price, you get it at this price. That is the perfect situation. Sometimes you want to get in at one price and you get a lower price, right? So it depends, if you're buying or if you were selling, right? If you're, let's just say, your price is price is over here and it's on its way up. It's on its way all the way up and it's finally reaching your profit target. When you finally want to execute, close off your trade at this profit target, price slips, right? And it comes down to here and you get lesser amount, right? So in this case, it is not so good. Slippage is bad for you. But if you were from the opposite position and you're coming all the way down, and then you were selling, you were trying to, you were going short, right? And you try to execute at this price, but price slips lower to here. That for you, is a good thing, right? So slippage can work both ways. It can be a good thing, it can be a bad thing, right? So Faith is asking, is slippage kind of like a delay? Yeah, slippage is something like a delay. So if you have like terrible internet connection, you're at a far, if the servers are in London and you're located at some funny island with, you require hamsters to power your power supply or something, right? And maybe you might not get the best fields, right? That's why some people love to have use stuff like VPS and have their accounts connected very close to the servers so that they have minimal slippage, right? So slippage is something which, even if you are located super close to the servers, you probably will have one way or another, right? And yes, Graham, it's true that during news events where the market, when the markets are slow, you might get a slippage like that. But if you're looking at crazy news events, the market might slip until like that, right? Because it's moving too fast, right? You just need to imagine, um, if you're a little guy over here, right, and just say, and there's a train, you're trying to catch a train, right? You're trying to catch a train, you're trying to catch a train, right? If the train is stationary, right, it means that there is, it's very easy. You can get on and get off. You'll probably not slip when you try to jump onto it. If the train is moving at a slow speed, right, you jump, maybe it's, traveling at a very slow speed, you can probably jump on it and, still get on it, right? But if the train is moving like super duper fast, and I told you to jump on the train, there's a high chance that you might not survive that jump, or you might jump on, you probably will not land the exact way that you wanted to land. So think about that in the form of like slippage, right? If the markets are moving super volatile, super fast, there is likely to have a lot more slippage depending on your connection, depending on where you are and stuff, right? So Ray is asking about VPS, right? I'm I think so. There's this thing called VPS, virtual private server, right? So if you have unstable internet connection in your house, right, it is recommended to go for VPS. I believe IC Markets does have a few tie-ups with some VPS providers. So if you have a certain amount of money in your account, you might be able to qualify for a free VPS. I need to double check on that again. But if you are using a robot to trade for you, that trades very fast, or your strategy requires you to get in and out fast with minimal slippage, right? Then do consider getting a VPS. But if you are a guy who takes a trade, he goes on goes to sleep, right? Goes to sleep, and the next day, then you look at the trade again, then you don't need to worry too much about slippage, right? Slippage usually matters a lot more when you're trading super fast moving markets. If every time you look at the market, it's like you look at it a little bit at night, then one day later you look at it again, if it doesn't affect, doesn't affect you that much, you don't need to go for something like a VPS, right? And Albert, I think you can, right? You need to check with support team whether you can get a VPS from IC Markets. But yeah, if you're going to get a VPS, go ask the support team at IC Markets, because they would know which ones are located the closest to their server and which one they have the best kind of like performance records with, right? So lastly, I don't want to digress too much, being super duper wary of time, right? There are three main trading sessions: Tokyo, London, and New York sessions. That's why the markets are open 24 hours. When Tokyo is open, right, just before it closes, London opens. Just before London open, New York opens. Just right after New York kind of closes, actually, there's Australia here that opens, followed by Tokyo, London. That's why the markets are on 24 hours a day, 5 days a week. Okay, so when people are talking about the different sessions, that is what they're talking about. Right, let me see if I have another picture. Nope. Okay, now let's go on to the next one. Types of trading styles and their time commitments, right? So types of trading styles and their time commitments. Okay, so this is what I mean by the different trading sessions. Sorry, this is what I mean by different trading sessions, right? Based on the time hours, right? So we're talking about like during winter time and summertime. But let's just say, we look at the normal, like you just look at this, right? You can see that when Sydney opens, Sydney and Tokyo are open at the same time. Tokyo is spelled with a Y, not I, I'm sorry. Then, there's this overlap here. Tokyo, London overlap, Tokyo, London overlap. Tokyo, shucks, I need my pen again, right? So you're looking at the overlap. Oh man, just give me a second. What's wrong with my pen? Need to figure out why my pen is not working. Oh yeah, there you go. Right, this is the overlap, right? Overlap is where the most more trading activity happens during the overlaps, right? So you can see the good trading times are these times over here. Now, one of the most popular sessions is this one here. It's called the US London overlap, right? When New York and London overlaps together, there's a lot of stuff going on around here. US London overlap. Usually the majority of movements, big movements happen during this time, right? The Asians hours are tend to be slightly quieter, but yeah, they do have a little bit of movement there too. But yeah, these are where a lot of the trading happens. The US London overlap. Okay, I do want to touch a little bit on trading, right? Let me see how much time we have left. Okay, we have a little bit of time left, right? So I do want to touch a little bit on trading. So there are four kinds of trading strategies, trading styles. All right, we'll go into trading strategies later. Yeah, but there are four kinds of trading styles, right? We have the scalpers, right? Scalpers, they get in and out in a couple of minutes, in a couple of hours, usually minutes, right? Day traders, they hold their position maximum within the day itself. They will try to close their position within the day itself. Okay. Now there are the swing traders. Swing traders hold their positions for slightly longer, couple of days, couple of weeks, right? They are the longer term traders. And position traders, they are the longest term traders, right? Imagine you're looking at the US now and you're like, man, they're gonna be printing a lot of money, right? They're gonna be printing a lot of money, so I expect the US dollar oversupply is gonna weaken. And which country might be strengthening? I think it seems like China might be strengthening, right? And so I might just trade USD CNH, right? I might sell the US dollar and I might buy the China yuan, right? So in this case, I will go short on this. Okay, and this one you hold it for the entire year, 1 year or something. These are position traders, right? They use a lot more fundamentals. Scalpers use a lot more technicals. Okay, scalpers use a lot more technicals, right? Now, thank you for the compliment, Timmy. So guys, can you guys tell me or share with me what kind of traders, what kind of trading styles and time commitment do you guys have? And also, if you have any questions about the type of trading styles and how you can learn to be like or train yourself to be like different kind of trading styles. So Christopher, yes, it is possible that you get the presentation. All of this is recorded, right? All of this is recorded, and you go to icmarkets.com/blog/webinar. Right? I'll send the link in here later, right? And you can actually have access to it. And you have access to it, you'll be able to view it. Of course, I won't be able to answer your questions there, right? But yeah, there's a place where all of this is recorded. Right, so most of you guys I notice are scalpers and day traders. Scalpers and day traders. We got Craig, who's a position trader, and we got Sarah asking, does whether you long or short a currency pair. Oh, this is a different question. Does the long and short of a currency pair define the strength of a currency? Essentially, yes, right? When I'm talking about this case here, when I say I want to short dollar CNH, what I mean is that I expect the dollar to weaken and the CNH to strengthen, right? So the dollar CNH together, it will go down, right? But let's go on that later, right? So I do see a lot of people saying they're scalpers and day traders. And we got Roland asking what kind of trader am I? I'm a day trader and a scalper. I'm a crazy scalper, I tell you. I go in big, and each time I go in big, I look to get out within a couple of minutes. But why I'm a scalper, all right? I'll just share with you guys a little bit here, since you guys have been sticking with me for for quite a while already, right? And I'll not share with you why I'm a scalper. Okay, why I'm a scalper is because in Forex there's this thing called known unknowns. Okay, there's this thing called known known unknowns. What that means is that you know it's coming, but you don't know the outcome. Known unknowns. You gotta excuse my terrible handwriting. Right? You get a stylus or something. But yeah, known unknowns. Okay. So you know it's coming, but it's an unknown outcome. So these are most commonly seen in news events, right? Non-farm payroll, um, non-farm payroll, RBA announcements, ECB, a lot of all the different news events. We know the exact moment is coming, right? That's what the Forex economic calendar is, but we do not know about the outcome. And the problem with this is that when it is unknown, you cannot measure it. If you can't measure it, it affects your statistical probability of you being right? If I have a strategy that works, 60% of the time, I have a strategy that works 60% of the time, but this exists in an environment where there isn't a wild random event moving it, right? If every time I trade, then the next second Donald Trump decides to tweet about the US dollar or something, that is something which hardly any form of technical analysis is able to properly forecast, right? So I like to scout because I like to get in and out of the market fast. Right, I like to get in and out of the market fast. I don't like to get in and wait the whole day. Many news events happens, many things can happen in the world, whether a new COVID, 19 vaccine is found, a new strain of COVID is, new strain of COVID is found, right? So many different things, Myanmar does that little coup, so many different things can happen, right? So I like to get in and out fast because when in and out fast, I have minimal exposure compared to here where I have super big exposure to many news events, right? So as a scalper and usually as a day trader, right, you get to minimize the amount of known unknowns. But there are different styles of trading. Doesn't mean that scalping is the best, right? Doesn't mean that scalping is the best, right? There are many ways to trade, right? And each one you need to have a different trading strategy. Swing traders, on the contrary, right, swing traders tend to perform the best when it comes to using technical analysis, right? Because they can filter out a lot of the noise that happens on the daily basis, right? So interesting things. Okay. I know Zenel, I didn't touch on liquidity. Liquidity just means my earlier part here on liquidity. Liquidity basically means how liquid a market is, meaning that, for example, okay, if you have an iPhone, right? If you have an iPhone, let's just say you bought the latest iPhone, right, guys? If you bought the latest iPhone and you wanted to sell it in the second-hand market, is it easy to sell? How many of you guys can give me a quick answer there? Yes, it's easy to sell because there's demand, right? Let's just say you have a Nokia. I'm not sure if you guys know Nokia 3210, right? But you have a Nokia 3210 and you try to and if you try to sell it and you want to sell it at the same price you bought it 10 years ago, can you do that? Would it be easy or would it be tough? Yeah, a lot of you guys saying are tough. Yeah, but that is essentially what it means. Liquidity. How many people are in the market for a certain product? All right. So popular things tend to, you tend to get a very good price, low spreads, are very popular products like the majors, right? But if you go into the exotic currencies like the dollar ZAR, the African rand, and stuff like that, right? That is where it's the spread is not so good. You don't get the best prices, right? So that's basically what liquidity means. It directly affects the kind of markets that you trade in. Okay, so yeah, we naturally, if you want to get the best prices, you look for the best currencies with the best liquidity, right? Usually the majors, right? Usually the majors. Okay, now I'm getting a lot of questions, and we actually have crossed the, oh goodness, the 1 hour mark. But I'm glad to see almost 98% of you guys have continued to stay all the way, which is amazing, right? I hope I'm not boring you guys. I hope I'm not boring you guys too much. Right. Drug dealers' phones are easy to sell by O'Brien. I'm pretty sure they are. Those burner phones. That is true. That is true. You know, a lot of drug dealers use the Nokia phone. Don't ask me how I know that, but yeah. Um, moving on, technical analysis versus fundamental analysis. Okay. Yeah. Let me just touch on this, and if we have time, I'll answer the rest of the questions later. Okay. Technical versus fundamental analysis, right? It is not a question. It's not a question of whether which is better, fundamentals or technicals. Although I do have to say that usually when in trading, it's usually nice to have to combine both. You know, to cut this rope and combine both, right? If we see that the market is, risk off, right? If the market is risk off, for example, this is a very generic kind of example. If the market is risk off, then stuff like gold should be rising, right? So we look at stuff like XAU, USD, which is gold. Basically, it's the symbol for gold in terms of US dollar, and we will look for a way to buy it, right? So we look for a way to buy gold, and that is where we look at technicals, right? Maybe we look at stuff like, price finally breaking out, pulling back and going up, right? So you combine the fundamentals with the technicals, to trade well, right? That is how fundamentals and technicals work. You don't need to trade. It's not a versus kind of thing, right? A best case scenario is that if you through this series that we're gonna be doing, right? You'll be learning a lot. You'll be learning the fundamentals. You'll be learning the technicals, and the best thing to do is to combine them together to trade better. Okay, guys. So so some of the things that you will notice about fundamentals, right, at its very very basic, is that a good economy means that there's a higher currency value, right? The currency will strengthen, and if your economy sucks, I mean, if your economy is not so good, doing so good, right, the currency will weaken because less people want to invest in that economy, right? You see, China has been, for example, strengthened because so many people love to invest in it because they're strengthening so much. There are many things that affect the economy, right? There are many, many things that affect the economy, right? But at the very, very basics, this is before we dive into a lot more the technicalities of things, right? Fundamentals is that, this is how it works. Good economy, you get stronger currency. Bad economy, you get weaker currency, right? This is at the crux of it, what it essentially is kind of about. Right, so we got Delton asking, do scalpers earn less than any other styles? Nope. Scalpers and day traders and swing traders and position traders earn and lose, I say they have the potential to earn and lose the same amount of money. Just that you need to find a trading style that suits you. If you have only 10 minutes to trade in the day because you're so busy, you have a full-time job, you come home, you have your wife, you have the kids, you have the dog, you have your cat, maybe your fishes, right, to take care of, right? It can be a very, you don't have that much time to trade. So if you don't have that much time to trade, what you want to do is you want to look for a trading strategy that has a least time commitment, probably something along the lines of swing traders and position traders, right? And we got Joa, I can't pronounce the name, sorry, asking if I will be teaching my scalping strategies. Yes, I'll be teaching my scalping strategies and what makes up my scalping strategies throughout this entire webinar series. So guys, I'll be with you for the long haul, right, over the next, I think, couple of months, right? And we have many exciting things coming along the way. A VIP research portal for you guys to practice your analysis, and of course I'll be sharing with you the trading styles I have, the trading strategies I have, what has made money for me really well over time. And yeah, you just gotta stay with me through the entire webinar series, right? And we got Naomi asking if I combine fundamentals and technicals. I do, right? Not all the time, but I usually look at fundamentals to know when I stay out of the market, and technicals I use it for scalping. right? Someone saying, do I use stop loss and take profit for scalping? Yes, I do. Trading without stop loss is crazy. Okay, just trade with a stop loss all the time. That is proper risk management, because when you have a stop loss, it means that you know when you are wrong. You know when you are going to close that position and you're going to say, I'm wrong. And it's okay, because based on the law of probability, this is a game of probability. One day I'll be right, right? So you must always trade with a stop loss. And usually for risk to reward purposes, I look for take profits too, right? I got questions asking, yes, got your brain more important than your heart. I think there was a question on, I think it was a mentality or something. I can't find it, but I think I remember I saw some question on trading psychology, like how do you not panic so much when you trade, right? So how I trade is I usually have a checklist. I have a checklist of 3 boxes. If all 3 boxes are met, I will take the trade, right? Maybe I put 3% on my trade. If only 2 boxes are checked, right, I'll put 2% on my trade. If 1 box is checked, I will not even take the trade. Okay, so I have a very systematic way of trading, right? I have a systematic way of finding my entry. I have a systematic way of finding my take profit. I have a systematic way of finding my stop loss. When it comes to trading, entry, take profit, and stop loss are all equally important. It's not just one is more important than the other. They are all equally important. Okay, so yeah, how you determine your take profit is as important as how you determine your entry and how you determine your stop loss. Most people, when they trade, all they think about is just the entry. They don't worry so much about the stop loss and take profit, and we'll be covering that in the future, right? So a lot of people asking me what are the 3 boxes. I can tell you, it revolves around Fibonacci retracements, extensions, support and resistance, right, and a little bit of correlation. And the boxes basically mean are your criterias, your 3 criterias that need to be met before you take a trade. All right, we will go more into this in the future because we have already crossed the 1 hour mark, and I can still see 90+% of you guys are still here, which is amazing, right? But don't worry, right? Because come ready with your questions, and the next round we will be able to take your questions. Okay, and I'm being super duper wary of time, right? So let me see if I can find the place. Let me erase all drawings. If you go to icmarkets.com, okay, I'm gonna see, let me see whether I'm sharing with you all the correct screen. Can you guys see? Yeah, there you go, IC Markets, right? icmarkets.com/blog/webinar. Okay, I'm just gonna copy this and I'm gonna paste it in here. I'm not sure if you guys can see it, right? I'm gonna paste it here. Yeah, but this is where, oh, I can't paste it. Yeah, this is where you find it. You go to webinars. How do you exactly navigate to this page, right? How do you navigate to this page? How you do it is when you're icmarkets.com, just in case you don't know, right? icmarkets.com, go to more, and you want to go to market analysis blog, right? And once you're over here, right, you can click on webinars. You can click on previous webinars too, so, and of course you can see the previous webinars that we did, right? And well, today is the introduction to Forex, and if I'm not wrong, 2 weeks from now we'll be looking at I think it'll probably be support and resistance, supply and demand, right? So that is how that is how you can sign up for the upcoming webinars. And before I end, guys, right, let me just share my let me go to my dashboard again. We'll be having some pretty awesome giveaways over time, so it'd be pretty cool for you guys to hang around, right? What I want to do is, okay, the Q&A session, guys. Sorry, but we are running out of time. Just come prepared with your questions. I'll try my best, to answer your questions throughout. If you can do me a favor now, right? If you can do me a favor, right? So this is just for my own improvement, right? What I kindly like to request you guys to do is, if you can just rate this webinar from 1:5, right? Just to let me know, one being terrible, five being great. Don't worry if you rate it number one. I might or might not hunt you down, but at least let me know one thing you like about the webinar and one thing which I can improve on the webinar, right? So that I know when I am covering the future webinars with you. I think we're going to go on a long journey together. It's a huge webinar series. How I can find ways to, better improve the webinar experience for you guys. Okay, so yeah, just type it in the chat. One is to five. Whether you find something good or bad, and what can I particularly improve on, right? So thank you. Yeah, for whatever reason you type it in, just feel free. I'm not going to take any offense or anything, right? Just give me good feedback so I know how I can improve. Right, I can see someone says 4.012 without spread. Thanks. Right, David is saying that like, it'd be better if I can start with the jargons, right? See number of fours, number of fives. Thank you very much, guys. I really, really appreciate it, right? And I can forget about the questions there. Yeah, I know that's true, Roland. I tend to. Yeah, you have no idea, right? I have hundreds of questions coming through, and yeah, I'll try better to kind of answer them along the way. But it's nice to see that most of you guys give me a 4 and 5. Feel a little bit rushed. I agree, it's a little bit rushed. I'll try to put the webinars into more little bite-sized contents. All right, Mr. Lee Doran. But thank you. Right, answering questions can be distracting. I agree. I'll find a better way to do that. Now, thank you very much for the overwhelming response. Yeah, I use a touchpad. I agree. My some of you guys saying, Diane says my writing's terrible. I will find a way. I guarantee you, I'll find a way to improve my handwriting. It is not usually so bad, all right? But yeah, I'll find a way to improve my handwriting. Okay, thank you. Yeah, and Jeff, if you can asking how I can join me in Singapore, right? I think I'll be able to share with you guys more, but yeah, just search Desmond Leong. You can find me everywhere, right? You can ping me. You can easily find my contact details on LinkedIn and stuff to ping me too. But anyway, thank you very much, guys, right? Thank you very much, guys, and thank you very much from IC Markets. Remember, this is just the start of our series, okay? So go onto the webinar section and sign up for upcoming webinars. You'll see me very often. I'm the guy who posts all the daily analysis on the blog, on Telegram, doing the webinars for you guys. So you'll be seeing a lot of me. So no harm getting to know me a little bit more. Yeah. All right, that's it for me. Thank you for staying throughout and take care. Have a good rest of the week. Cheers and peace out, guys. Bye bye. Wacom tablet. Thank you.